Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. In my regular Wednesday episodes, I talk about the theories, methodologies, and principles associated with making high-quality investment decisions. The aim of these case study episodes is to demonstrate how it all works out in real life. And today's case study, there's a few themes. The main one is you got to know when to hold them and know when to fold them, which is a great line from Kenny Rogers' great song called The Gambler, which was produced in 1978. Okay, I was 4 years old at the time, and for most people listening, they probably won't even know what I'm talking about, but that's the key line. Know when to hold them, know when to fold them. And I think this is really pertinent with investment decisions, and it's really easy to measure the holding decision, right? Because each year you go and review your financial position, you're faced with the outcome of that holding decision. However, the folding decision, we don't often sort of go back and go, well, was that decision correct? Now, we do in our business because we like to learn from, our own experiences. So if we've decided to sell a particular investment, was that a good idea? We will always ask ourselves that question. And, I think it's important because it's easy to sell or react to a certain situation. And you don't necessarily, you might forget the fact that you've done that, but really 10 years later, you actually could be in a worse off position. So I think there's a lot of value from just holding and doing nothing. And sometimes that can be our advice. And it might seem like, do you need to pay for advice just to do nothing? But it's really about, is it ultimately going to contribute to your financial future? If it does and you've achieved your goals, then I would say it's really good advice. Anyway, let's get into today's case study episode. We started working with these clients in around mid-2016, so around about 8 years ago. At the time, the clients were approaching their 50s. They're in late 40s, 48, I think, to sort of be exact. And I'll give you a little bit of a rundown of their situation, their financial position when we started working with them, and of course then what their financial position is today, and some of the key sort of highlights or learnings, I guess, we can take away from working with these clients. So when we began working with them, they had net investment assets of around $900,000. So in a pretty sort of healthy position. They had their home was worth $1.85 million. They had about $145,000 of debt against the home. So we can see $1.6 million of equity in the home. They had a couple of investment properties that they bought in 2012 and 2013. So 3 to 4 years prior to them engaging us for financial advice and to build a long-term plan. Around mid 2016, one apartment was worth $570,000, had $520,000 of debt, so only about $50,000 of equity. The other one was worth $550,000 with about $530,000 of debt, so about $20,000 of equity. So a couple of investment apartments, but really not very much equity. The client had a portfolio of direct shares, only about sort of 5 or 6 different holdings, and the majority was in a couple of US listed shares, and they were employee shares that the client had purchased when he was employed by that US global company, and then had a self-managed super fund with really $550,000 of cash. So the super wasn't really invested at that time. It was all in cash. I can't recall how long it had been in cash for. I'm not sure if it was in cash for a long period of time or what drove the client to that decision in the first place. I can't recall that, but I remember them coming to me with, and that was the main issue is, okay, we've got these property assets that we've accumulated. That's great. These things are going to work, but really, what are we going to do with super? And there was some other super accounts, just had some insurance in them. It was about $50,000 of combined balances there. So the wealth was really a little bit of equity in a couple of properties, some direct shares, and then super. And that was the $900,000 of investment assets. Okay, so where's their position now? Well, their home's now worth about $2.5 million, no debt. so they've repaid the home loan. The two investment properties, one has about $180,000 of equity and the other one has about $70,000 of equity. So when we met, they had about $70,000 of equity in property, and that's grown to about $250,000. So it hasn't shot the lights out by any stretch of the imagination, but I suspect or have strong confidence the next 10 years of returns will be fantastic. The direct shares are now worth $560, so they've grown from $230 to $560, which is about $330,000 uplift. Again, most of that $330,000 is in, I think, two of those US shares. I think most is in one, in fact. In 2020, we sort of talked very deeply and considered very deeply about whether to buy a holiday home. So the idea was, let's go and buy that home now. We might be able to use it a little bit between now and retirement, but ultimately that's where we would like to retire to. So we talk a lot about it. So in 2020, which is kind of good timing from a COVID perspective, April 2020, purchased a home for $1.35. That property would be now worth more than $2 million. But I remember spending a lot of time thinking about it because it was going to give rise to a lot of debt, right? We spent $1.35 million. So we had to go and borrow $1.5 million. And the question then was, well, what else could we do with that money? Would there be a better way to, divert some of that cash flow, either continue to build super, do those sorts of things? Only after a very short period of time, so 4 years, or just a little over 4 years. Of course, we look back now and go, that was a great decision, but it was something that we thought very carefully about. And super is now worth $1.46 million, call it $1.5 million. So there's been a significant uplift in that. As well as we invested in the last 2 years, we invested in a couple of unlisted office investment trusts. So these investment trusts have internal gearing. They go and borrow to buy office buildings. Unfortunately, they haven't worked out. I mean, it's been well documented about what's happened to sort of office as an investment asset class, and then particularly the challenges that Melbourne itself has had with prolonged lockdowns and so forth. So we invest about $500,000 in those, so $250 each, and they're now worth a combined value of about $335,000. So there's a paper loss on those investments of about $165,000. Now, normally a financial advisor wouldn't talk about investments that haven't worked out, and I'm loath to actually say that they haven't worked out. Of course, 2 years later, yes, they haven't, but we're not making an investment to generate returns over 2 years. But I'm going to come and talk about, that's kind of one of the reasons I wanted to record this case study episode, is because when we make investments, things can change. But if the thesis hasn't changed, the original investment thesis hasn't changed, then it's about having the confidence to stick with that investment rather than making some sort of knee-jerk reaction and giving rise to a loss. All right, so really if I summarize what's changed between 2016 and now for these clients, $180,000 of equity in property, a $330,000 uplift in shares, an $860,000 uplift in super, which probably around 350-ish has come from contributions, and about $500,000 of growth in income, and detraction from that net asset value of $165,000 because those commercial property investments and how they're valued at the moment. So the net investment assets then for these clients are $2.6 million in total. So it's gone from 900 to 2.6 over the last 8 years, almost a threefold increase. Not quite, but we can see where that's come from. Now the clients have a high income. Family income's over $500,000, depending on bonus income and so forth, could be materially over that. But they've got high expenses too, and really, whilst they do have a high income, the only capital contributions they've been making towards this retirement strategy, super contributions, which I've sort of called out. The rest of the income certainly gone towards servicing the debt, investment property holding costs, definitely. And then the rest has gone to lifestyle. So while these clients do have a high income, their contribution to the returns is really limited to, holding costs and the superannuation contributions. Okay, so as you know, I like to sort of sit back and ask myself, what could we learn from this case study? And what are the sort of key takeaways, if you like? I think the first one is, returns are random. I'm going to write a blog about this. We don't want to award the premiership at halftime. We wait until the game is fully played. Okay, so you've always got to return back to the investment thesis when you make the investment decision. If you decide I'm going to buy this property and I'm going to sell it in 5 years' time, then it's okay to assess the returns after that 5-year period. If your idea is I'm going to buy this property and hang on to it for many decades, there's no point beating yourself up about the returns after 2 or so years, if it's been a short time, because in the short run, timing can have a big impact. You make the investment at a completely wrong time, but the completely right investment, when I say right investment, the quality of the investment is strong, then in the short run, it's all about when you made that investment and very little about its actual quality and attributes and fundamentals. But the longer you hold that investment, the more the timing impact gets diluted. So yes, we should try and aim to get both of those things right. But the thing that we must absolutely get right, even at the cost of timing, is the actual investment fundamentals. Particularly, and I'm talking about making long-term investments here. So, the property investments that the client made before they engaged our advice, looking back at it now, you'd go, well, maybe they shouldn't have bought 2 apartments. Maybe they should have bought 1 house, combine that budget into and bought 1 great property. And I think, with the benefit of hindsight, that would have achieved a better outcome. But it's unfair to make that assessment now because when those clients bought those properties, they didn't say, okay, we're going to buy these assets to maximize our return over the next 8 years or 10 years or whatever it's been, because I think one's actually bought in 2012, so maybe 12 years, whatever it is. I'm sure when they bought those properties, their intention was to hold for many decades and enjoy compounding capital growth. And we know, we looked at a property more recently that a client had held between 2009 and 2020. It did very little, very tiny growth rate, something close to inflation, 2 or 3%, and it's done 27% since 2020. So it shows that, there's a long period of ownership there where the client hadn't actually enjoyed any returns, and the returns have come all in the last 4 years. But when you have a look at the average return over the holding period, it's not too bad. And property can behave like that. So it's really important to not be too, I think, unfair. You've got to go back to what your investment thesis was. Now, the commercial property investments that we made for this client certainly were terrible timing. On the backdrop when we made the decision was that the rhetoric was really interest rates are going to be low for a long period of time. There wasn't many asset classes that were deriving predictable levels of income. Bonds at the time were paying sort of 1 or 2%. And we were keen to kind of build some diversification into the strategy because we had shares, we had residential property, and we wanted to add commercial property. Now, if we had, with the benefit of hindsight, of course, we would go, that's silly timing. We'd actually make that investment today rather than a couple of years ago. But we're using an approach that has worked for 3-4 decades. It's got proven returns in terms of the way that we're doing and business that runs that investment. And so the thesis hasn't really changed. And when we made that investment, we knew we're going to hold that investment because it's an income style investment. That is, the longer you hold the investment, the better the income is, especially relative to your original investment amount. We knew we wanted to hold that to, offset some of the negative cash flow with the residential properties. And I think that thesis is correct. Unfortunately, returns to date, paper returns have been pretty poor, but we don't need a lot to change in that space for that to turn around. So that's why I wanted to talk about it, because I guess when we make an investment, the market can change a little bit and things can move against us from a mark to market kind of perspective. We look at, well, what if we sold this investment today? What would we generate in terms of returns? But that's why know when to hold them, know when to fold them. It's really important to have the discipline and fortitude to stick to the original plan, to stick to the original sort of fundamentals and thesis around the investment, not get distracted by, the short-term performance. And that's really where long-term investors are rewarded. So returns are random is kind of my first insight. And, I think that's a common theme, by the way, through these case studies that I've noticed. It's been an interesting exercise for me as well, seeing that, quite often we'll be investing in 2, 3 to 4 different asset classes and they haven't all performed well. The only one that's performed well, I think, if we have a look back, is I did some case studies that right at the beginning where I was dealing with some clients. I had those clients for 20 plus years. That's when they've had more uniform performance performance where we've had much longer holding periods. My next observation is that doing nothing can be just as rewarding as making changes. And so that I'm referring to the employee shares that the client held. They've actually done very well over the period of time, and we could have easily sold them. We could have easily gone back to the client and said, oh, look, they're international shares. They're a bit of a pain to keep. We should just clean it up and move that equity into something else and something a bit more diversified. Because as you know, certainly our methodology and approach isn't to invest in direct shares. But what we do is we look at the fundamentals of those shares or any holdings. And unless it's compelling to sell or even make a reduction to the exposure, we're kind of reluctant to do so. And it sort of reminds me, sometimes we feel like, well, we're paying for someone to make a recommendation. Normally that recommendation is to do something. The recommendation do nothing might seem kind of lazy or valueless, but really it can be very valuable. And the flip side to that is when we do make investment decisions, it is actually important to go back and say, how did that decision work out? Now, you might have made the decision to produce a good long-term outcome. That's fine. There's no point going back and saying, oh, I sold these stocks and, 3 months later, they're higher than they are today if that wasn't the original thesis. So what I'm saying is still stick to that long-term, but it's really important where you've said, no, let's hang on to these assets even though we didn't recommend you buy them in the first place and we wouldn't necessarily go and buy them today. Let's hang on to them. If they're going to generate a lot of value, then, there's value in that recommendation. So again, knowing when to hold them, knowing when to fold them is really important. It really does come back to the fundamentals for me, because it's possible that I'll go and say to a client, look, we should sell these stocks. If it's not making any money, the business isn't making any money, the valuation is totally overcooked. I might go to a client and say, sell that. Now, that stock might continue to run in terms of appreciate and share price. But when I'm making a sell recommendation, I'm really thinking about where will that stock be in 10 years from now. I just don't see any value in selling a direct share if it's undervalued or has really strong fundamentals that aren't reflected in the current share price. I would rather say, let's hang on to it for a few more years and let the market hopefully work it out. Final couple of observations with this case study is, again, I can't remember the circumstances of why the client came to us with a self-managed super fund with $550,000 in cash. But if you're going to set up a self-managed super fund, have a plan. Now, obviously, maybe this client's plan was to come and get some advice. And if so, that's fantastic. But actually, I would have preferred perhaps that client to come to us before he set up the self-managed super fund, before he started, making those sorts of decisions. Anyway, I'm not going to pick on this client because I don't remember the circumstances, but I guess what I'm saying is if your plan is to do something with super and you go and set up a self-managed super fund, just don't leave it in cash, because there's a lot of, when you look at the ATO data, and they publish the data on this, there's a lot of self-managed super funds hold a lot of cash, and it's really worthless. People get an idea, I'm going to take control of my super, and then sort of half implement it, and the years go by and their super's not performing as well because it's underinvested, of course. So that was just something I wanted to mention. From these clients' perspective, they're now 56. They'll probably work for another 5 or so years. Over that time, super will continue to compound. I estimate the super will be, it's about $1.5 million today, should be worth probably around sort of 2 to 2.5 by the time, another sort of 5 years, just because of that, how compounding works. They'll be in a position where they can keep the couple of investment properties for another sort of 10 to 20 years perhaps, sell those, say one or even both of those investment properties, and then they'll be able to extinguish all debt. Meanwhile, our commercial property investment will start to generate an income, and that'll be positive cash flow and tax effective, so that'll also help them hang on to those properties as well. And they might be in the very enviable position of being able to maintain their home in Melbourne and then have the beach house as well. But certainly if they do downsize to one of those properties, they will have more than enough wealth. So certainly on the right track, and it's working for them. We don't necessarily need all assets to work at the same time. Would be lovely if they did, of course. I'm not going to argue against that. But it's really about keeping a firm sight on the long-term outcomes. Okay, let's get into some questions, some listener questions. First one is from Matthew. I'll just read it out. Debt recycling using negatively geared investment property to recycle non-deductible home loan debt into deductible debt for investment purposes. I've heard your views on rent investing, which is a great concept, but my wife and I much rather having our own home and seeing the debt recycling give us as much benefit as rent investing. That is, providing your home is investment grade and will deliver strong returns of 7% or more compounding capital growth. Ways to continue building your property portfolio if your household income only grows in line with inflation. Rate of return on lower quartile properties are much higher than upper quartile properties in each city. Will this continue, or will quality assets start to outperform? So, I've just read that verbatim. I don't really understand all the comments you've made there, Matthew. I think just to unpack it, certainly for listeners, when we talk about debt recycling when it relates to investing in property, there was an idea, and I remember, in fact, writing about this probably about 15 years ago. So there was an idea that involved go and buy yourself an investment property. Of course, we all know that investment property is going to be negative cash flow. There's a holding cost associated with it. For the sake of using really round numbers, let's call it $20,000, which might be, say, $30,000 of income and $50,000 of interest expense. Okay. And so the idea was that why don't you get yourself a line of credit or some sort of facility, and this is particularly the case if you have, quite a lot of equity in property, and instead of paying the $50,000 of interest cost, why don't you borrow that and add it to the loan, and then take the $30,000 of investment income and put it into your home loan. And by doing that, what you're essentially doing is repaying your home loan, your non-tax deductible home loan at an accelerated rate, because you're putting all the investment income towards that, in return for giving rise to more tax deductible debt. And so long as it all sort of worked out from a interest rate serviceability borrowing capacity perspective, mathematically you're sort of recycling that debt from being non-tax deductible to being tax deductible. I was never really in love with the strategy, and it could suit some people depending on their cash flow position, but I would much prefer, probably 99% of the time, to see people use their own cash flow to meet holding costs of property rather than continuing to increase the debt. Because obviously we know capital growth isn't uniform, and what happens is you risk a situation of having negative equity in a property. That is, that you owe more than the property is worth at any particular time. Plus also, I think that strategy has been misused over the years as a way of affording to hold on to a property. And so some people might think, oh, look, I'll go and borrow the interest cost, and that way I can spend a little bit more on living expenses. And so it's been a way to sort of not have to make any compromises and still have the investment. But again, we've got to remember that we're giving rise to more debt. And so long as we're repaying our home loan at a much, much faster rate, then our overall debt shouldn't change. But as I said, I think it's been misused a little bit. So they're the comments regarding to debt recycling as it relates to property investment. I know I've mentioned or answered questions about debt recycling as they relate to share investing in the past. So that's the first part of the question, I guess. The other sort of observation that Matthew shared with us was, he made the comment, I'll read it out again, the rate of return on lower quartile properties are much higher than upper quartile properties in each city. I remember citing a report by one of the real estate firms about 6 months ago where they did some analysis for Sydney property, and they concluded that the returns over the last 10 years were higher for higher quartile properties. Now that's the last 10 years. I do have, and I mentioned it before, a really strong feeling that the relative value of properties that are in outlying areas relative to the value of properties that are in blue chip locations. If I could chart it somehow, I don't think I could find the data. I don't think the data is really going to help me very much. I've spoken about, some of the inconsistencies around suburb-based data, but if I could find the data, I would love to be able to explore it. I don't think we can. I don't think we can do an analysis around it, but I certainly think that, I've got to spend $1 million to go and buy a house in a relatively new build area that, might be 30 or 40 Ks away from the CBD, which creates a lot of transport issues if I'm working in the city and all those sorts of things, that sort of property, if I'm describing it correctly, versus, I can buy a house for, say, $2 million in a blue chip suburb, that has a lot of amenity, and I can actually then walk to work. Again, if I work in the CBD, the relative value of those two sort of property or types of property, if you think, I think is the narrowest it's ever been in history, at least, probably the last 30 years, the time that I've been looking at property. So yes, Matthew, I think it will turn around. I don't think the relative value makes sense. Why would I pay $1 million for a home, in a regional town in Victoria versus $2 million for a house, albeit a different size house, say in a really good quality blue chip location in Melbourne? Doesn't make sense. Don't think it will persist like that, and I think it will actually turn around. Okay, I'm going to squeeze in one more question from Anonymous. I'm pretty sure that's not their name, of course, but they obviously don't want to disclose their name, so that's fine. I'll read out the question. We're in our 30s and 40s. We have one home and one investment property and are debating what to do next. We have equity in those properties. So one property is valued at $855,000, the other property is valued at $810,000, and they have $776,000 of debt against both those assets. At least that's how I understand it. We have a $100,000 emergency fund, which we plan to put in an offset account now the interest rates are higher. Combined super of $350,000. We can't decide whether to go hard and smash the mortgage. They mentioned $328,000, so I'm assuming the $328,000 is the non-tax deductible mortgage. Invest more into shares, or whether to increase our super contributions to 15%. I'm aware you can't give personalised financial advice, but we're now getting analysis paralysis and would appreciate your thoughts. Great question. I kind of like these questions because it allows me to sort of talk through what some of the things I would be thinking about, and not only will hopefully it help this listener, but also it might help other listeners. So, the first thing I think about is the listener said, well, they haven't given me their income, which would have been useful, but they said they're in their 30s and 40s and they've got $350,000 of combined super. Just also for your information, you can send a question in. The more specific it can be, the better off it is. So is it early 40s, late 40s, mid 40s, and so on and so forth. So I'm going to make some assumptions here, but my assumption is and I don't know the income, as I said, the super balance is a little on the low side. I think you've done the hard work. You've got a home, $328,000 of home loan debt. I'm going to make an assumption that's not that material, given your age and stage of life. The $320,000 of debt is manageable to repay between now and retirement. Again, hard to make that decision because you haven't told me your income. But the super is a little bit on the low side. If the investment property that you've got, which you said is worth $810,000, I'm not too worried about the debt against that property. Again, it is what it is. It's just a question of, will that $800,000 property be worth, say, 1.6 in 10 to 12 years? Because if it is, well, I'm not really worried about debt management or debt repaying or anything like that. You said you're in your 30s and 40s, so I don't know if I really want to put a lot of money into the share market, to super, I should say. At this age and stage of life, you do want to give yourself a little bit of flexibility. So I'm starting to think, invest more probably in shares. I'm not really worried about, you said you could smash the mortgage. I think that would be probably the wrong thing to do because I don't, your compounding return's not that huge. And it's really about getting growth assets and building that asset base, not really about debt management. Again, keep repeating myself, but I don't have your income, so I don't know. If it was a very low income, then maybe it is more important. But if you've got a strong surplus income, which it sounds like you're good at managing cash flow because you've got the emergency fund. So I don't think debt repayment is a necessary priority. I'm not saying don't repay anything, but I don't think I'd just be solely focused on it. So from what you've told me, and let's assume that your investment property will start generating some good compounding growth over the long run, then I probably would be inclined to invest in shares with the idea to do that for the next sort of period of time, 10, 15 years, with the view to gradually moving those shares into super eventually as well. And you could do that because shares, you can be incremental with them as opposed to property. It's one big lumpy asset. So with shares, for example, I could move some into super by making a non-concessional contribution. Sure, that would trigger capital gains tax, but I could offset that by making tax-deductible concessional contributions. So I therefore reduce the amount of capital gains tax or maybe even eliminate it. And that's what I'd be looking to eliminate eliminate it, then therefore get that money into super. So the idea would be in my 30s and 40s, keep those assets outside of super, give myself flexibility, it's not locked away. And then when I'm in my 50s and 60s, gradually over time each year, depending on my tax position and so forth, and whether I'm utilizing the full concessional superannuation cap, gradually move those assets into super. Don't have to always do it necessarily by age 60. It might take you a little bit of time, no big deal. So yeah, that I'm still attracted to having those assets inside super by at some point when I'm in my 60s. But whilst you're working now, I think I'd like to have the flexibility to have those assets outside super. So I would be inclined to put some of my cash flow towards debt reduction, get rid of that non-tax deductible home loan. I wouldn't worry about any of the debt associated with the investment property, assuming that investment property is going to grow over time, and then puts the remainder of my cash flow into the share market. And I might even put some into the share market and some into super, sort of balance that out. Again, I don't know how much money we're talking about in terms of surplus cash flow, but that's what I'd start be thinking about in that situation. But thanks so much for your question. And if you do have more questions or feedback, you can get me at questions@investopoly.com.au. I can't give you specific personal advice, of course, but actually the more details you give me about your situation, the more I can be specific, and I will still try and answer these questions in general terms to obviously help everyone else that's listening at the same time. Okay, that's it for me for today. Until tomorrow. Bye for now.